very, very warm welcome to all of you joining us. I'm Pranav from impact measurement and customer insights company 60 Decibels. I co-lead our work in financial inclusion and also the growth of our work across Europe and Asia more broadly. I am so delighted to be speaking with and hearing from incredible colleagues and friends really from organizations, VisionFund, Global Partnerships, UNICEF USA, and Accion. I will be handing over to them to introduce themselves in just a second. But before I do that, just two quick things. One, I wanted to introduce really the goal for today's webinar. First, we're really excited to emphasize the importance of better understanding the impact of financial services on the lives of children and their caregivers around the world. Second, highlight preliminary findings and signals from the data that we've collected as part of the 2025 Microfinance Index, but also honestly share lessons and open questions from this first inaugural edition and think about how we can deepen and strengthen the approach going forward. And then last but not least, we have some really experienced practitioners across the spectrum from organizations focused primarily on children's well-being, as well as others who have a social impact focus, but are also interested in deepening their child-focused impact. And so it's really about hearing granular lessons about what we all can do better to deepen child-focused impact. Once again, for those of you who just joined us, please do introduce yourselves in the chat. We'd love to hear who you are, what work you do, and where you're calling in from. And then second, we have an incredibly exciting, full agenda for this 60 minutes. And so we are going to try to both speak as slowly as possible while also trying to leave, 5 to 7 minutes at the end for Q&A. In the event that we can't answer your questions or get to your questions, please don't hesitate to reach out to any of the five of us with any specific questions that you'd like to learn more about, and we'd be happy to speak to you after today's session. With that, I will hand to Erin, Josh, Meghan, and Kathleen to introduce themselves and their organizations.
Thank you, Pranav, and thank you so everyone for joining. I am Erin Egan. I am the Managing Director of the Impact Fund for Children, where I lead our work on child lens investing. The Impact Fund for Children is UNICEF USA's impact investing affiliate, where we develop and deploy innovative finance solutions that advance UNICEF's mission for children worldwide. So thank you all for joining, and I will pass it to Josh.
Hi, everyone. My name is Josh Olson. I work for VisionFund, which is the financial services arm of World Vision. So World Vision is one of the largest humanitarian aid and development organizations in the world, and it's exclusively focused on child well-being. So glad to be with you all.
I will jump in next. Nice to be with all of you. My name is Meghan Flaherty, and I lead impact measurement and management as the VP of Impact at Global Partnerships. Global Partnerships, for those not familiar with us, is an impact-first fund manager dedicated to expanding opportunity for people living in poverty. We provide impact-first capital alongside advisory support to social enterprises in Latin America and Africa. Both financial service providers alongside agricultural co-ops, health clinics, and other social enterprises. Over to you, Kathleen.
Thanks, Meghan, and great to be here with everyone. My name is Kathleen Yaworsky. I lead our impact work at Accion, which is a global nonprofit on a mission to create a fair and inclusive economy for the nearly 2 billion people who are failed by the global financial system. We do this through targeted investment strategies, but also advisory solutions, research, and thought leadership, where we work with local partners to develop and scale responsible financial solutions for small businesses, smallholder farmers, and women to improve their economic well-being and increase resilience. Now, if we were to situate ourselves on the impact capital spectrum, Accion, as an impact investor, seeks risk-adjusted market rate returns and focuses primarily on productive MSME lending. In that context, a child lens is not our primary focus, but it is implicit in sort of broader theory of change that small business growth can lead to not only positive enterprise outcomes, but also positive household outcomes, including for children. So happy to be here. Back to Erin.
Yeah, thanks so much for the introductions, Erin, Josh, Meghan, Kathleen. Again, super excited to have you here. Erin, really over to you to introduce the child lens investing approach.
Perfect. Thank you so much. UNICEF launched the UNICEF launched Child Lens Investing through the publication of the Child Lens Investing Framework and Toolkit around 2.5 years ago. Child lens investing, by definition, is an approach through which investors intentionally consider child-related factors to advance positive child outcomes and minimize child harm. It is applicable across all investment strategies because, as we believe, all investments affect children, whether those effects are good or bad, direct or indirect, yet children remain absent from investment processes and decision-making. So today we're here to say, why bring a child lens to financial inclusion? And with that, I want to start with one statistic from this report to really set the stage. One that illustrates the degree to which financial inclusion is affecting children. And that one is that of the report that published by 60 Decibels, 82% of the MFI clients surveyed had children in the household. And just so you know, there was no intentional effort to collect information from more caregivers. So when you start to combine the 82% with the reach of the financial inclusion sector and the average household size, you really begin to see the scale of the opportunity and the responsibility. By order of magnitude, financial inclusion is influencing the lives of nearly 300 million children a year. So for us, the question is not why apply a child lens, it's how. It's at that magnitude, children are one of the sector's largest stakeholders, whether we face that head on and intentionally or not. And so you might be asking yourself, okay, so what does that look like? What does a child lens look like in financial inclusion? And I'm going to put that on our theory of change. So we have a theory of change for child lens investing more broadly. That theory of change, there are two pathways. The first pathway, one pathway is for policies and practices. So that is where investors can drive responsible business practices for children through diligence and stewardship or engagement. Now, what that might look like in financial inclusion could be detecting and mitigating against child labor, or understanding the true impact of repayment burdens on children in the household. On the right side, now we have the products and services pathway. That's a pathway where investors can intentionally select and optimize investments for positive child outcomes. So what could that look like in financial inclusion? I think we're going to learn a lot more of this with our wonderful panelists too, doing the work, but what it could look like is, say, tailored lending models to maximize specific child outcomes. So access to education, healthcare, or safe sanitation. It could look like savings or insurance products that promote income stability and resilience to mitigate against financial shocks in the household. Or it could simply be working on ways to expand your reach to ensure that you are supporting more underserved caregivers and children with more fit-for-purpose solutions. So our theory of change between those pathways also then shows how together these pathways work up to strengthen children's health, education, protection, and development, which for us are the building blocks and one of our strongest assets, future human capital. And so in CLI, a very important premise is that over time, investing in children does not just improve individual lives, it contributes to a more productive workforce, stronger communities, and healthier and more sustainable economies. And so I can end with, once we establish children as a salient stakeholder, the opportunity becomes clear, and I really want you to take away two dimensions. So first, it's about children today. How can we better support the children now we now know we're already serving? As UNICEF says, poverty poisons childhood. 1 in 5 children today live in extreme monetary poverty, surviving on less than $3 a day. And because children are uniquely vulnerable, their bodies and brains are still developing, the effects of child poverty can last a lifetime. In protecting the children of today, we then leads to the second dimension of the impact. We believe one of the most profound opportunities for financial inclusion is to break intergenerational cycles of poverty. So how can we as practitioners ensure that our investments don't just improve today's household or business finances, but are changing the trajectory of the next generation? And so with that, I'm thrilled for this panel and to really dive into the details of the report. We UNICEF commissioned the Child Lens Investing module as a tool to begin to collect this evidence and this data to meaningfully build the field. And we hope that this will resonate with those who have joined today, and you will join us in this effort. And so with that, I will hand it back to Pranav.
Thanks so much for that introduction, Erin, and the overview of the Child Lens investing approach. I will quickly share my screen with an overview of how the Child Lens approach really came to life in the 2025 Microfinance Index. First up, just a quick check. Erin, can you see my screen? And hopefully the others too?
Mm-hmm.
All right. So just a first introduction to, really set the context for today's conversation is that in 2025-26, in this edition or the fourth edition really of the Microfinance Index, we listened to 24,450 clients of 85 financial service providers in 39 countries across Asia, Africa, and Latin America. This is an annual, incredibly meaningful initiative intended to raise the voice of communities who are recipients of microloans, microcredit around the world. And this is incredibly important because it really is the foundation that enables us to bring a Child Lens to impact measurement. And so over the years, since our start in 2022, we've really been building this momentum of listening to a significant proportion of the global microfinance market with the intention of both understanding its impact, understanding its risks towards, as Erin mentioned, maximizing the impact and reducing the risk. So how does Child Lens fit into this? So in the 2025-26 edition, as Erin mentioned, we collaborated with UNICEF USA, Global Partnerships, VisionFund, and Accion to both develop and deploy this lens to the Microfinance Index survey tool. So just as we ask a number of different questions about who's being served, the impacts of microfinance on their lives, client protection risks that need to be understood and mitigated, we added two additional elements that really brought a Child Lens to the index. The first was focused on segmentation. So for the first time in the index, we are able to, as Erin mentioned, understand the proportion of caregivers, i.e. those with children in the household, and others who are being served by inclusive lending products around the world. And again, it was the first time we have that data that about 82% of respondents are in fact caregivers. And this is something that we plan to now maintain within the index going forward so that when you go onto your dashboards where our financial service provider partners and our impact investing partners see their results on Signal on a platform where they can access the data, they can now see it segmented by those who are caregivers and not just as they would be able to see segmentation by gender or by tenure of respondents, which are incredibly important to make sense of the data and use it for decision making. And in addition to the segmentation across the entire data set, we also, for a subset of 18 financial service providers, had an additional module which went deeper into the impact of the financial service on a range of areas like education, housing, well-being, and of course, hazardous labor, which we'll go into as well. And that's aligned to the Child Lens investing approach that Erin mentioned and begins to capture caregiver perceptions about the impact of those services on children's lives. One of the things that really came up in our preparatory conversations for today's webinar was recognizing both the incredible step forward that this presents, as well as some of the limitations and open questions that absolutely need to be addressed. So first and foremost, now the biggest step forward we all felt was really around how financial service providers can now systematically understand who they're reaching and the extent to which they're reaching caregivers with a segmentation that's repeatable, comparable, measurable over time. And then the add-on module is one that offers the opportunity to go deeper for institutions that really care about that and want to go that step further. On the limitations, though, one important thing to recognize is this is by no means causal proof of impact. These are preliminary findings, observations, and interpretations from the early data we're seeing. Almost more importantly, we will be diving into differences in results as reported by caregivers and non-caregivers, but the sample is incredibly heterogeneous. We have respondents who are served by different loan types, different loan sizes in different locations. And so we need to be careful about how we interpret these differences that we're seeing in this inaugural report. There's definitely a question on sampling. given that the subsets for certain questions tended to be lower and something we would love to expand in the future. And one thing to keep in mind across all social research, especially on sensitive topics, is social desirability bias, among others, and something we try to limit as much as we can going forward. So with that introduction of the Microfinance Index and the integration of the child lens, I wanted to kick us off in the first section of today's webinar on the key theme of outcomes and what we're seeing in the data. So one of the headline findings that we noticed and that we saw in the data was that a higher proportion of caregivers reported gains across impact themes. And I'm just going to take a couple of examples here, which is to take, for instance, the impacts on business income and financial stress. So we see, for instance, that the dark yellow bar represents caregivers, the lighter yellow, those without children in the household, non-caregivers. And what we see is that across both financial and household outcomes, at the aggregate overall level, caregivers, a greater proportion of caregivers report positive impact. So 30% report very much improved business income versus 22% of non-caregivers. Similarly, about 27% report very much decreased time worrying about finances compared to 22% of non-caregivers. On the household side as well, you see it across quality of life, home renovations, meals, and healthcare access. So these are the preliminary findings on the impact side. And with that, we wanted to sort of change things as opposed to sort of presenting all the insights in one go, pause here for a moment and really hear from our experienced panelists on how they make sense of this data. And I'm going to start with Meghan, which is a question for you, Meghan, which is, as an investor, given you're seeing data like this for the first time, what were your hypotheses and what surprised you? And what actions does it really prompt for you at the FSP level at GP?
Thanks, Pranav. Yeah, I think while, as Erin shared, while the term and framework of child lens investing may be new in the past couple of years, the multi-generational household level impact that tailored financial products and services can enable for clients and their children have really long been part of Global Partnership's impact investment theses in microfinance. But the key gap that investors like us run into in seeking to allocate capital in an evidence-informed way through a child lens is lack of enterprise-specific data and client-level data to really understand and dimension that impact on children. So, for example, we can know, taking housing finance as an example, at the sector level, research tells us that 1.6 billion people lack access to adequate housing, and all of the ways that children specifically can be disproportionately affected by that gap. But data to dimension how a specific financial service provider reaches and creates value for children and their families is often non-existent. So the conclusion that from this data that FSPs reach a majority of clients with children and are enabling improvements in children's well-being was not surprising to us. But what's new and exciting is to have that data at the level of a particular FSP, which gives us as a fund manager, as well as our social enterprise investee partners, data to better dimension, scale, the nature and the magnitude of impact on children. As an investor, this helps us make the impact case for investment more fully and concretely and with evidence behind it. And it helps FSP partners better serve their customers. And to maybe give a more concrete example of using data that emerged from one of the child lens studies that GP supported along with 60 Decibels this year. So we supported studies with 4 of our FSP investee partners in Latin America who each provide a housing finance offering as one among their product offerings. And among those 4 studies, we found that 71% of home improvement loan borrowers had children in their household. And when we compared that to 60 Decibels kind of Latin America-wide child lens benchmark of 64%, what that tells us is that among these partners, children are slightly overrepresented in housing finance compared to other types of loans, at least for these particular FSPs. And then 83% of those borrowers reported improvements in children's well-being, naming things like improved living conditions, safety, happiness, health, and emotional stability as the most significant changes they observed for their children. And when you further segment then by gender, layering on top of that, you gain additional nuances into what female caregivers versus male caregivers are more likely to perceive and value in terms of child outcomes. And so what we see at our FSP partners is that they can use these insights to inform marketing and sales strategies for how their frontline staff engage with prospective clients. If you've got 80% of your clients in a certain product saying that here are some really important dimensions of impact from this product, that's a great thing to know in terms of how you approach and engage clients. And they can also use the data in fundraising efforts to attract impact-aligned capital that values that impact on children. And at the investor level for GP, the same data helps us make the case for growing our capital allocation to housing finance. I think sometimes investors or stakeholders might question the relative importance of the impact of a consumer loan product like a home improvement loan relative to more traditional productive use microfinance. But data from these child lend studies for us affirms that scale and depth of multi-generational impact that those types of products can have. The data does also surface many questions, perhaps more questions than answers, and we're not here drawing conclusions about causality. Or what this data gives us is directional insight from which we and our partners can then draw hypotheses around, okay, what factors might be contributing to the results seen, and what shifts in product design and strategy and operations and delivery might yield differences in results. So taking an iterative learning mindset is important. But those are some of the examples just to give a taste of how we see this data being used both by investors and FSPs as core business intelligence.
Thanks a ton, Meghan. The specifics around using it for sales and marketing efforts, the distinctions in data for housing loan FSPs or products specifically, as well as the iterative approach really, really track and really resonate. I'm going to now move to Josh, who, Josh, you represent a financial service provider network that is focused really first and foremost on children's well-being. And so I'm curious what questions this data raises for you and any immediate actions or opportunities that emerge for deeper impact at VisionFund.
Yeah, thanks a lot, Pranav, and thanks again. I had asked for this to be put, and I'm grateful for I think it's good for us to think about what this type of data is useful for. So at VisionFund, our viewpoint around this is that when you survey your customers for feedback, that's a useful management tool to improve your products, your services, so that you're meeting needs. It's not proof of impact, and it's very important that you don't speak of it this way. It's self-reported. We're the ones asking while providing a financial service. And so the way you can think about it is, it can be a signal or a flag to ask a question, to dig in and improve something. But it's not a causal finding. You need a counterfactual, which is what would have happened if you weren't there. And that's important from a child lens, because if we were to too quickly react to self-reported data and say, oh, let's just start lending to caregivers a lot very intentionally for that purpose alone, that could lead to perverse outcomes. You have to look at, because there could be trade-offs. One positive outcome might be coming at the expense of another. For example, if the child is actually the labor factor driving the income, we don't know. You have to really dig in. It's useful maybe if I share a bit about VisionFund. Despite being embedded in World Vision, it's only recently that we've really, really started leaning into a child lens and how that actually shapes the way we are thinking about things and how that transforms. Originally, the old logic was that World Vision did economic development, financial tools are a part of that. So let's do that, and let us focus on smaller loan sizes, rural families. It's microcredit, is sort of the focus, and we would count the child reach. And that was kind of the way it was for many years. But the way we've really been digging deep around this identity as part of child focus and what that changes. One of the ways that makes us think differently is people may perceive that they're getting benefits from loans, but academic evidence tends to show that actually it's quite heterogeneous. There's not a lot of there's not much evidence for income or savings growth, and it changes. And it makes sense because businesses actually are multifaceted. They have many different variables involved for their success. So what we do in partnership with World Vision is try to take an ecosystem approach. We look at all the different variables. So this could be training, not just training around businesses, but even just being able to set a goal for yourself and a vision, being able to look into the resources available to you in your community and be able to access those resources and capitalize on them. Market access. Does your business have a useful way to access markets? The ability to save and invest productively over time before you get access to responsible credit. And that's something we call Thrive, this ecosystem, and that's about enhancing the livelihood. But it's also the thing that keeps us up at night from a child lens is shocks. And so Erin mentioned shocks earlier. Speaking to clients in the field, if you think about sickness, if you think about a health shock happening to a family, think about climate shock. These are the types of things that can bring a child out of school, for example, having to work just for survival. Or if they're in school still, they might not be able to study still because they're on one meal a day, or the quality of food has decreased. There's a number of, as we call this, negative coping. And so for us, this has completely shifted our center of gravity at VisionFund to become very resilience oriented. It's changed the way we think about credit, and it's changed the way we think about insurance and savings. So we're much more focused on savings groups now. And we now have a much broader insurance reach than we do credit. So, we were about 1 million credit customers last year. Now we're about 1.6 million insurance clients as the end of last year. So that's growing. That's going to outpace credit quite a bit. And that's because we're really looking at, trying to follow the evidence around what could maybe make a difference for children. So when I think, when I look at maybe these trade-offs that might be emerging in the data potentially, for us, a very clear next step is we want to develop rigorous evidence around our ability to measure shock absorption, be able to share that with the sector so we can drive knowledge and learning around this. So be looking at establishing counterfactuals, being able to look at comparison groups between, say, those who are receiving an insurance product versus those who maybe receive a shock reactive credit when your livelihood's been impacted, those who have disaster preparedness, et cetera. So we can try to understand this better. So that's next on our frontier and where we'll be focusing.
Thanks a ton, Josh, for those the history, the overview of your journey from where you were to where you are, as well as the different forms of data that would inform the kinds of choices you make. And also really, really interesting to hear about the growth in your insurance offering, given the resilience boosting element of it for communities, in addition to credit. Kathleen, I'm going to move to you to get perspectives from the Accion side, because I'm super curious, what some of these findings opened up for you and, how your participation in the inaugural sort of child lens integration, how it shaped up.
Thanks, Pranav. Yeah, I think we really approach this exercise from sort of an exploratory stance of asking ourselves, what will this enable us to learn that we don't, what perspective does it give us that we don't have historically, and what can that enable us to do in the future? So, just the mere fact of being able to systematically know what % of clients have children in the household and have a better understanding of the dimensions of impact on those households and the children in them is in and of itself a positive step. And again, a level of granularity that we simply didn't have before at the portfolio level. Again, to Meghan's comment around, what is surprising, enabling improvements in children's well-being on average isn't something that we're surprised to see. I think, we expected to see that, and it's encouraging that this does bear out in our data, which again helps build the evidence base more broadly for our theory of change. But I think where it gets interesting is, for example, from a product design perspective, being able to dig deeper into the segmentation. So, for example, we saw a higher proportion of caregivers reporting significant improvements in child well-being for individual lending customers compared to group lending. Which is interesting. And then also for hybrid and in-person delivery models compared to digital delivery mechanisms. Now, again, I would, caveat this with all of the many things that we've been saying around sort of this is signals and not causal, but because there may be many factors that are influencing, these differences in outcomes beyond whether a borrower is a caregiver. But so I wouldn't immediately jump to tweaks in product design, but I think the segmentation and the level of granularity opens up new areas that we may want to probe deeper to unpack further. Why are we seeing those differences in outcomes across the different segments? And so what, does it eventually lead to some product tweaks down the road? And I think one of the potential so what's that the data opens up is new levers, and Meghan mentioned this as well, of positioning just the value proposition of different products, services, or indeed the broader customer experience for caregivers specifically. And I'll get to another sort of unexpected example of that later. But I think sort of all the whys and so what's lead to my second reaction, which is that really just going deeper into the data from this initial exploration raises almost more questions than answers, which again, from my perspective, is a good thing. Another sort of interesting thing that we saw sort of across the other outcomes cited in the report, things that 60 decibels typically measures, business income, savings, resilience, quality of life. We actually saw smaller variance paired with a higher floor in outcomes reported by caregivers and non-caregivers across the Accion portfolio compared to the global average. And in some cases, the direction was flipped. So a greater proportion of non-caregivers reported outcome improvements. So again, this raises questions on how are the many factors influencing these differences in outcomes, which all to say seeds, I think, a rich research agenda to probe further, continue to build the evidence base collectively, which again is why Accion participated in the first place. So from that perspective, very happy with sharing learnings here together.
Thanks so much for that, Kathleen, and especially the candor around some of the surprises or, at a first look, almost contradictions, it might seem like, between the data you're seeing and the data at the aggregate level and trying to figure out what the drivers are. And that's absolutely the journey we're on. And so, again, really, really appreciate those examples from your side. Sort of to move to the next section of our conversation, I'm once again going to share my screen. So you should let me know when you can see it. Can folks see my screen? If someone can just let me know.
Yes.
Okay, amazing.
I think you maybe have to put continue to share. Yeah, there you go. Now it's good.
Fantastic. Thanks so much, Meghan. So we've spent about 15 to 20 minutes speaking about the outcome side and the early signals and preliminary findings in differences as reported between caregivers and non-caregivers. But this next section, we really want to also focus on risks, and particularly risks both to children as well as their caregivers. So the first insight we want to highlight, and this is all available in the report that's publicly available, is that child labor risks really diverge sharply by region. And in sharing the finding, I wanted to first also explain how we've asked this question. So the question that was put to respondents, which is the chart on the left, is, have there been any changes in the work your child or children are doing that may interfere with their well-being, education, or safety? Now, the bar that is basically respondents who said it's increased, decreased, or not changed are classified as yes, indicating that they were involved or are involved in some hazardous activity. And it's important to note here that no change just means that it hasn't changed as a result of or since the loan was taken, right? And so those are the respondents who've been categorized as yes. And anyone who reports or selected that this wasn't applicable and that their children were not included in, were not participating in any of this sort of hazardous work are categorized as no. So as you can see, the prevalence, the self-reported prevalence of children in any form working in any of these hazardous sort of contexts varies quite widely by region. About 25% of respondents in Africa reported some sort of engagement in hazardous work by children. And then, it's 11% in Latin America and 3% in Asia. Again, preliminary data from what we've collected. And again, it's important to note here that this is an indicator that doesn't rely on a separate technical definition of hazardous work, but the respondent's own interpretation of what that is. And that's what this early data indicates. And then the chart on the right tries to understand the change in the children's involvement by region. And so here again, you see that for the majority of respondents, there hasn't been any change. It's encouraging to see the ones where it's decreased, but equally or more concerning for the proportion where it's increased. So that's one important piece of context. And the second is that when it comes to the caregivers themselves, we see actually pretty similar levels of worry, of stress, of experiencing any forms of unexpected fees or harassment as a part of their experience with the financial service provider between both caregivers and non-caregivers. And something, of course, being, given the knock-on effects on children within those households, especially for caregivers, something for us to be especially mindful of as we think about the implications of this data for both investors as well as financial service providers. And so with that, again, want to really get the group's perspectives on this. And my first question is to Kathleen, really, which is, how do you think about the role of such child labor risks within client protection more broadly, which is, of course, an incredibly important area of focus within financial inclusion?
Yeah, thanks, Pranav. I think, at a policy level, obviously child labor is at the top of our exclusion lists, and our ESG management systems monitor compliance and risk mitigation. And more broadly, we consider client protection risks as the most material for potential unintended negative impacts in the financial inclusion sector. So therefore, this is something we monitor very closely. Beyond policy level and compliance monitoring, this child lens data gives an additional level of granularity from the caregiver perspective versus what a loan officer might observe in a field visit, what we would see from the lens of the institution. Again, the initial signals are encouraging, with both the lower proportion of caregivers compared to the average reporting their children engage in activities they perceive as potentially affecting their well-being, 9% versus 14% in the global average, a higher proportion reporting a decrease in those activities as well, 22% versus 16%. But again, I would urge caution in how we interpret and act on these findings. So while I think it gives us an additional lens, it gives us a perspective from the caregiver themselves versus, again, what the institution is observing. How we act on that, I think, is something that still needs to sort of be worked out. And when we were digging deeper into this data as well, one sort of surprising finding that we found that we observed was while the incidence of harassment was on par with the global average, and there was no difference between caregivers and non-caregivers, for those who said they experienced harassment, caregivers were twice as likely to actually report the harassment to the FSP, 18% versus 9%. I don't have necessarily a hypothesis for why that is, but I think what's interesting about it, to my earlier point on customer experience, is that a potential hook that we could explore to encourage reporting, really leaning in on the caregiver dimension of borrowers. So again, just one small example there, but I thought it was interesting to share.
Thanks so much for that, Kathleen, especially that stat around twice as likely to report. And again, taking it with caution and curiosity about what that indicates and how it can be used. Josh, moving back to you, obviously you shared the context up front about the level of focus and intention that you at VisionFund have now with the child lens integration. And so could you share some examples of tools or frameworks that you use at VisionFund to better map risks to children where you work, and also how to support teams in deepening their impact on children?
Yeah, thanks. And just to comment too, we this was one of the questions we maybe had some skepticism around. So we're like deeply supportive of trying to measure the negative effects that can hit children, including child labor, but not limiting to child labor. But just to be careful as you further dig into the data, I think with this is, ILO definition would have a broader set, right? And so there'll be sort of hazardous would be a subset of that. Hazardous labor is maybe a smaller subset the percentages we're seeing. And this was an add-on module, so it's a much smaller sample size. So certainly there's signals there that need to be dug into, and it's a pressing issue, but just a caution there for anyone who's going to be, I think, trying to do further analysis. So VisionFund, so just I'm going to share some tools. We're part of World Vision. We have the luxury of getting access to some things that maybe your standard financial service provider doesn't get to have. But I want to push back on the idea that this type of thing is only for mission-driven organizations or organizations with a very child-centered focus. The whole point, I think, of what Erin was talking about in UNICEF Child Lens is that it's a journey, and you start taking into account these really important considerations. And there's actually really easy things you can do to start down that journey. And so in VisionFund's case, just very briefly on child labor, but again, there's much broader sets of risks to children that we're worried about. But we do have a pretty serious effort around safeguarding. So we're really trying to move beyond a policy approach, but really having a well-developed protocol in place where you can understand and help recognize in a financial services context what types of child labor you might be encountering, who you should partner with in addressing that, when or should you even encounter that, or does that pose a risk to the child? When do you invoke? There's lots of decision trees involved, and it's not a simple topic. It's very complex, but we're really trying to move the needle around that and equip our teams. We're also trying to address it from a sort of supply side perspective, where even in the communities we're working in, we work in partnership with World Vision around mindsets and views around sometimes there's gendered effects. So having the gender of dependence would be a very interesting analysis in the future to understand if girls, for example, are being treated differently than boys in some of these cases. Now, one of the things I mentioned earlier about shocks and negative coping and hitting the nutrition of children, not just the education or labor. And so one of the tools we're really excited about that we've rolled out in partnership with World Vision and the Institute of Economics and Peace is called the Multidimensional Child Vulnerability Index. And it's kind of like if you work in the climate, for those of you in the climate space, if you're trying to look at a climate risk mapping tool where you want to understand your raw risk and then how you can respond to that. This is a geospatial mapping tool where we can bring in different dimensions fed by at a sub-regional level that are fed by very credible external sources coming from academic institutions, multilateral organizations, and they're dimensions of vulnerability for children, like it could be disease related, so say vector-borne diseases. What's your exposure to vector-borne diseases in an area where your branch is operating? Or what is your exposure to climate events, say coastal flooding risk or drought risk? What is multidimensional poverty looking like where you're operating? And what we're doing in our business planning process right now is we're actually mapping our branch footprint and our product growth footprint against these specific vulnerabilities. And we're challenging our teams and saying, hey, you actually have you're growing your branches in less vulnerable areas, but you actually have the capacity to grow more here. Is that something we can do? What's the cost of doing that? You have a particular vulnerability to these types of climate events or these types of health risks that could be impacting children. Could you be tailoring your products accordingly? And there may be a good reason for not doing that, but it forces you to explain that, right? And to understand it and to go take a level of rigor deeper and then maybe be able to price those decisions. You can think of it as maybe a useful overlay on a reach indicator. So rather than just looking at who you're reaching, look at the type of vulnerability and then bringing in that depth. So how can we bring in savings and insurance to build resilience on top of maybe more tailored credit products? Now that might sound complex or something, but actually, it's not. We've got this wonderful opportunity now, thanks to UNICEF, who have founded a community of practice with different practitioners and investors who've come together trying to solve how to better shift our existing practices and tools or build new ones that can be easily made available to many others. And so right now we're getting help from some other folks in the community of practice, a development bank and a private investor, another NGO, et cetera, who can give us different perspectives, test the tool. And if we find that it works, then it's useful. And we couple this, with the more rigorous evaluation evidence that I talked about earlier, right? These things are play two different roles that are hopefully complementary. And if we find that's working, then we can roll that out. And there's many other things that community of practice will help do. whether that's in due diligence or what themes you might be looking to allocate capital based on evidence, academic evidence, and rigorous evidence about where you might have an impact for child well-being. And so that's moving, in a wonderful direction. And so my encouragement, I think, wherever you're sitting, whatever organization you're in or what role you are, find a simple step. If you're a financial service provider, it might be saying, hey, how can we get more into the insurance game? Or it might be, how can we get more into savings? If you're looking at data, it's maybe how can I start looking at children in a different way, because you're understanding such an important part. There's a saying, children 1/3 of the world, but it's 100% of the future. It's something we have to contend with. And so there are small steps now you can start taking to advance on that.
Thanks for that. Thanks for that, Josh. And of course, if there's more questions that folks have about the specifics of those models, I'm sure you can reach out to Josh and the VisionFund team to learn more about them. Meghan, moving to you from the investor perspective, how does global partnerships approach the issue of risks to children first and foremost, and then how are you and your partners on the FSP partners and those who may not be have Child Lens as central to their work as VisionFund? How do you envision them using data on the risk side?
Yeah, I think data to dimension risk in the specific operating context of an FSP is super valuable, since it can inform decisions about the need for risk mitigation, among which segments and with what resources. Typically, there is very little such. If I look across our portfolio, I would say typically MFIs are operating with little to none of such data. And VisionFund, as Josh has just described, is obviously really on the leading edge of best practice in this dimension of capturing all these different types of data and using it to inform business planning. And that's the direction we want to support our partners in moving towards. Because in the absence of that data to dimension the scale and the nature of the risk, social enterprises and investors apply risk mitigation practices, as Kathleen noted, but with limited visibility into the risk prevalence or the effectiveness of different risk mitigation strategies. So this the data, the directional data from this Child Lens index initial effort is really helpful, as are the different types of data that Josh is talking about. So to double click on the risk of child labor, and a data point that we saw, one of our FSP partners in these studies found that 21% of its borrowers reported children participated in work that might interfere with their well-being, which was much higher than the regional LAC average of 11%, and of course much higher than the 0% that all of us and they might hope to see in an ideal world. But what that data point signaled to the FSP is their awareness of the risk of child labor in their operating context and the value of additional measures to mitigate them, such as guiding loan officers to flag instances where they observe minors working and to work on that type of protocol that Josh, you were describing, of what to do when that happens, and what are the ways in which that might inform the loan application decision or the engagement with that client, as well as also proactive mitigation initiatives like training for parents in the interest of promoting awareness of the importance of education, the harms of or the potential harms, and how to engage children responsibly. So yeah, this finding is definitely a reminder, and this data is a reminder that the presence of positive outcomes for children does not imply the absence of risks, and that at the investor level, effective impact underwriting needs to assess the potential for both, and supporting, as an investor, wanting to support our investee partners to adopt right-sized risk mitigation strategies that are really appropriate to their context.
Meghan, thanks so much for that very specific example, and also really giving an example of how the data becomes about management rather than proving or disproving something, but really helping an FSP understand its context, and then either at the loan underwriting stage or just in terms of getting that prevalence or that data be more deeper to flag such cases is super, super helpful. So thanks so much for sharing it. Erin, we've been talking a lot about the, in this report, and obviously in the examples, a lot about the prevalence of child-focused risks in the context of financial inclusion. And given that at UNICEF you have a much broader purview, Are you able to share a bit about how child labor risks are tackled in other sectors and industries? And is there something for us to apply or learn from in financial inclusion?
Yeah, to build upon what some others have said, first to set a little bit of the context in financial inclusion, one thing that we are have a heightened awareness of, and as with panelists, is that child labor exposure in the financial inclusion sector may show up differently than in other sectors. It may not be outsourced labor, it may not be it's maybe household businesses. It isn't as much as a larger supply chain issue than in other industries. So that context is important to have. And I would say there's two things to walk away with. And so the first is, as we've kind of gotten through, and Pranav, if you walked through the methodology to even ask this question about child labor, I think a really important piece is to know that not all children working is child labor. Some levels of safe and appropriate employment in or out of the home can build agency and add positively to development. So it is very important to understand that context in your detection and your diligence strategies. So we've used the term a lot here, hazardous, and I think that there's hazardous employment or employment that will prohibit or hinder the well-being of children, access to education or play. And so that is a piece that I want to make sure that people walk away with in your detection strategies. And then the other one is that the strategy doesn't end at detection. So UNICEF, in other sectors, UNICEF does a lot of work to drive a solutions-oriented approach. We work a lot with the investment community to drive awareness of their of positive actions beyond diligence. So, for example, we work with investors on what child-friendly remediation looks like. And so, if in financial inclusion, if you're exposed to hazardous work or work that prohibits education or play, and that's what your FSPs are uncovering, the call on financial inclusion might be to ask the questions, can some of the products be designed to allow families to rely less on child labor? And I don't want to diminish the difficulty of answering that question. I know that that is a hard thing to potentially put into practice, but something for financial inclusion providers to consider.
Thanks for that, Erin, and especially the distinction between some forms of sort of engagement outside the household, which could be deepening from an agency point of view versus hazardous labor, as well as the second point around how we can actually reduce that to, as Meghan mentioned, the ideal benchmark of 0%, which is what we're all aspiring to. So having now covered the piece around early signals on outcomes as well as on risks, and really curious to hear from you, a bit around the way forward and whether we call it the way forward, the business case, how we really deepen this collective focus on the child lens. And the first question for you is what would you say are the biggest opportunities and barriers to deepening a child lens integration in financial services?
Yeah, I think we covered so many of the opportunities already today with these amazing panelists. For us, the opportunity is 300 million children that deserve this. Children are a critical stakeholder, and how do we use that opportunity to drive transformational impact for the next generation? To focus on the barriers, I want to mention three. So first is building the ecosystem. I think, as we've all mentioned, this report has been one first critical step to explicitly unlock some of the data. But in the long term, building the ecosystem could look like building and advancing more child lens IMM solutions within financial inclusion. It could be bringing child lens investing principles into current standards setting frameworks and standards agencies. All of this type of work UNICEF is committed to do this. And Josh mentioned the community of practice. UNICEF has launched a community of practice for child lens investing this year. And that's where we can hear firsthand from investors what is needed to strengthen the infrastructure of child lens investing. I think the other barrier I want to mention is capital. So this is a call to all the allocators. I think that we consistently hear from our managers that managers have to ultimately respond to the priorities of their investors and their funders. And for allocators that want to reverse trends of poverty, that want to explicitly recognize one of the field's largest stakeholders, it's an ask to work with their managers and allocate capital towards their managers to advance child lens investing, to do it in partnership. And the third is a broad kind of category of expertise. We really understand at UNICEF this is a new field, and we recognize that financial institutions are not necessarily child development experts. We need expertise across the entire ecosystem, from the allocators, the managers, and the FSPs themselves. building that child lens expertise is something that UNICEF is deeply interested to lean into with the field. And we know that we need to translate child expertise and evidence into the practical tools that the field needs.
Erin, if I'm just going to try to summarize that, just to make sure we get it again, it's the 300 million opportunity, which, as Josh rightly pointed out, is 100% of the future. And then the three, barriers, again, which can translate into opportunities are more IMM tools, capital that acknowledges the importance of child lens, and then expertise more broadly. And with that, I guess in the last 4 minutes, the big question I would love for you to leave all of us with, Erin, is what are your calls to action for all of the players in the financial services ecosystem, the impact investors, financial service providers, and others? What would you ask everyone to leave this session with?
Yeah. Well, first, I have gratitude for your interest to join the panel today and hear from the panelists. And I think that Josh hit on one of the biggest takeaways for us. And it's if you're on the call today, find a feasible entry point and start there. I think the most important takeaway is that this is not a new complete framework to adopt. It isn't all or nothing. There are multiple principles of CLI which fit into the field's best practices. So, for example, we know that loan officers interact with communities, and as Josh mentioned, a starting point could be to build a child safeguarding policy into your existing client protection systems and your codes of conduct. VisionFund has one. The IFC Good Practice Note on child safeguarding is a good resource for private markets. And then if you're allocator or an intermediary, you could start just by asking some of these questions to your portfolio. I think, the questions will always send the signal of what the market values to continue to build out the ecosystem. So find somewhere to start. Perfect is not the enemy of the good. And then also reach out to us if you have any questions. We have the framework and this report and some other resources that UNICEF has been working on our Child Lens Investing website.
Amazing. Thanks so much, Erin. There was just one question in the Q&A box, which I'll quickly answer. And then while I do that, because we, are doing so well on time, maybe Meghan, Josh, Kathleen, I'll request each of you for one big takeaway / call to action from your perspectives. And so the quick question in terms of how we actually collected data on caregivers and non-caregivers, that was, again, entirely self-reported. So we asked respondents, of the total number of members in their household, how many were above the age of 18 and how many below. And that helped us basically segment households into those that had children versus didn't. So that's kind of the primary way we collected that data. With that, maybe Meghan, I'll start with you, and then Josh and Kathleen with one big call to action from this from the ecosystem that you'd love to leave us with.
Yeah, I would. I mean, it's similar to what Erin said. It would be start from where you are, and the first step for us is always thinking at a investment thesis level at a certain product or service. How might children be impacted there positively or negatively, and then moving from there into what data do you need to kind of inform that strategy.
Josh, if you want to go next.
Yeah, I think you got to think of where you are, but there's definitely something. There's there's an example I think of recently with insurance where people have a low trust of it at times, and understanding your customers, understanding their needs, including the family needs, is a good way to actually break through that. If you think about what might happen to your kids if you're not there anymore with regards to education or healthcare, that can be something that people can understand a bit better, and it can help you understand how to better serve them. So I just think wherever you are, if you're a commercial player, you could find some way to be better serving your customers. And if you're a mission focused org, I think we really need to push the evidence needle for us. I'm glad to see MFI Index putting this lens, and I hope it'll continue to refine. We ourselves are not in that anymore, but we'll be finding other ways of evidence that we hope will build on some of the questions raised here today, and we want to share that with folks and just see it continue to evolve.
Great. Kathleen?
Yeah, I think I would just double click on that point of building the evidence base and really sort of a call to action to dive deeper into some of these questions and sort of unpack take this as a starting point as signals and where we can tease out causality and dig deeper into what's really driving outcomes for children.
Fantastic. Well, once again, a huge thank you, Erin, Meghan, Kathleen, Josh, for an incredible conversation. We hope everyone, all of those attending, really, took at least one new finding away, new insight away, and new action to improve impact for children and reduce the risks on their lives. So thanks so much, everyone, and hope to see you again soon sometime.
Thank
Bye-bye.
you.
Thanks, everyone.
Thank you. Bye-bye.